Today, we will talk about hobby loss, what it is, how it works, and how to avoid it. A hobby loss is a loss that results from a business deemed to be a recreational activity or hobby by the Internal Revenue Service. Taxpayers cannot claim and recoup this money when the agency says it is spent while pursuing a hobby. That's because losses aren't allowed for expenses in excess of hobby income. This means these expenses aren't deductible as they are with a business. Expenses are an expected part of running a business. You have to spend money to make money. Expenses that are necessary to carry on a trade or business, incurred to produce income, or paid for investments in your company are deductible. When, despite a profit motive, your overall expenses exceed your earnings, the loss can offset unrelated income. Any income you earn is taxable and must be claimed, even if it doesn't come from your employer. Expenses related to these activities that result in a loss are generally deductible. The hobby loss rule of the Internal Revenue Code attempts to curb perceived loss deduction abuses by hobbyists. It applies to individuals, S corporations, trusts, estates, and partnerships, but not to C corporations. Taxpayers engaged in these activities must establish a profit motive to avoid the hobby loss limitations. Proof of profit motives include receipts and detailed record keeping, which is a good idea for every taxpayer in any situation. The IRS published a tip sheet to help taxpayers distinguish between hobbies and legitimate business operations. Prior to the 2018 tax year, you were allowed to claim itemized deductions as itemized on Schedule A of Form 1040, assuming you were engaged in a hobby and not a covert or nascent business. The Tax Cuts and Jobs Act eliminated miscellaneous itemized deductions between the 2018 and 2025 tax years. In 2017, President Donald Trump signed the Tax Cuts and Jobs Act into law. The 200-page law went into effect on January 1, 2018, and made sweeping changes to the tax law, including changes in the tax bracket, mortgage interest deductions, medical expenses, miscellaneous expenses, and itemized deductions. Once the TCJA was signed, any expenses or hobby losses that a taxpayer was able to claim to reduce their hobby income in previous tax years are no longer allowed. This applies to tax returns filed between the 2018 and 2025 tax years. The easiest way to avoid the hobby loss rules is to frequently turn a profit. The hobby loss rule presumes that an activity is for profit if the operation is profitable for 3 out of the previous 5 years ending with the current taxable year. For actions involving horses, the time frame is 2 of the previous 7 years. If the presumption is not met, then the taxpayer must establish a profit motive. A hobby loss refers to any loss incurred while a taxpayer conducts business that the IRS considers a hobby. Here are 5 key takeaways. 1. A hobby loss refers to any loss incurred while a taxpayer conducts business that the IRS considers a hobby. 2. The IRS defines a hobby as any activity undertaken for pleasure rather than for profit. 3. Income derived from all sources, including hobbies, must be reported to the IRS. 4. Prior to 2018, taxpayers were able to deduct some losses stemming from the activity if they didn't exceed the gross income for the activity. 5. The Tax Cuts and Jobs Act eliminated all itemized miscellaneous deductions between the 2018 and 2025 tax years. Hope this would help. Thanks for watching.